One stock that has seen massive growth and massive dividend growth over the past decade is MasterCard, stock ticker MA, trading at $462.45 per share. And over the past year, it's done very well, up around 22%. But here's what's really impressive. Over the past 10 years, up over 524%, way outperforming the market. So in this video, I want to discuss if this type of growth is still possible moving forward for MasterCard. So to get a general overview of how MasterCard has performed and some of the key metrics over the past decade, let's go ahead and jump over to my stock screener spreadsheet. And like always, you can get access to any of my spreadsheets and the ticker data add-on that allows you to automatically import stock financials straight into your spreadsheet by heading over to tickerdata.com at the link in the description. So let's go ahead and come up here and plug in MA and hit enter. And you can see all this data is going to automatically load in. Now, immediately we can see there's a lot to like about the company. Let's take a look at revenue per share. 2013 sitting at $6.89. 2023 jumped all the way up to $26.59 per share. The same happened with earnings per share. We saw massive growth over the past decade, and the same is true with free cash flow per share. And remember, free cash flow per share, in my opinion, one of the most important metrics we should be looking at, because that is how a company can reward their shareholders by reinvesting back into the business, buying back shares, paying out dividends, attempting mergers or acquisitions, or paying down debt. So again, this is a key metric we should all be paying attention to, especially for dividend growth investors. And if we come down here, we can see one of the ways they were using their free cash flow was to buy back shares. And this is something we'll touch on here in just a moment, but also we can see this is a quality company. How do I know this? Look at their ROIC, that is return on invested capital. In 2022, sitting at over 51%, in 2023, 52.81%. A high return on invested capital is a sign that we are looking at a quality business. Now, if we go ahead and jump over to the profitability and income statement sheet, the first thing I want to point out, look at this gross profit ratio, sitting at 76% for 2023, and it's been sitting close to that average over the past decade. So a very highly profitable company. And if you look at the 5 and 10 year revenue CAGR and the 5 and 10 year net income CAGR, both very impressive metrics in the double digits. Now, if we jump back over to the stock screener tab, let's talk about free cash flow per share again. We already know the company is rapidly buying back shares, but how much are they buying back and how else are they rewarding their shareholders? Well, this is something they talked about in their 2023 annual report. If we come down here, we can see in 2023, they had $11.2 billion in capital returned to stockholders. Now, how did they do this? We can see the company repurchased over 9 billion shares. That is a massive share repurchase. But we can also see they paid out around $2.2 billion in dividends. So they do pay out dividends, but the big focus for this company is repurchasing shares. Now, to be fair, when you repurchase shares, it does allow the company to more easily increase the amount they pay out in dividends over time. And if you're not sure how, I'll go ahead and link a video down below explaining how that works. But let's go ahead and jump into the dividend metrics for this company as well. Let's go ahead and come up here. We'll plug in MA and hit enter. And again, thanks to the ticker data add-on in Google Sheets, all this data will automatically load in. Now, we can see the starting yield for this company is very low, sitting at 0.57%. So not a high starting dividend yield at all. But the magic of this company is not in the starting dividend yield, it's in its ability to reinvest back into the business, allowing it to continue to increase the amount it pays out in dividends over time. And if we look here, we can see the 5-year dividend CAGR sitting close to 15%. Now, the 10-year in this scenario actually isn't accurate, and I'll tell you why. In 2014, this company went through a stock split, and so this is something we're going to be updating in ticker data soon. We're going to be adjusting this data for stock splits, but it's important to keep that in mind. But the 5-year dividend CAGR sitting at 15%. But here's what's really impressive about this high dividend growth company as well. It's completely backed by free cash flow, and here's why that's beautiful. When the dividend growth is backed by free cash flow growth, we don't see increases in the free cash flow payout ratio over time. So for example, we can see FCF payout ratio currently sitting at about 18.59%. That is an extremely healthy range, and we can see over the past decade, that's pretty much what it's been close to the whole time, with the exception of a small spike up in 2020, but even then, it was still in a very healthy range at 24%. So again, we'd love to see dividend growth backed by free cash flow growth, and we can see this portrayed pretty easily when we look at the free cash flow versus dividends paid out chart. We can see over the past decade, the free cash flow generated from this company is easily covering the dividends that are being paid out. So what does that allow the company to do? Well, like we've already seen, they are rapidly buying back shares, but they can also heavily reinvest back into the business, allow them in turn to generate more free cash flow and to generate more dividend payouts in the future. This is a beautiful dividend growth company. Now, like I mentioned earlier, we need to assess, is this same growth possible for this company moving forward over the next decade? And they do have some advantages, and let me explain why. In 2022, the digital payment market size was estimated to be around $84.5 billion. Now, that in alone is a large market size, but here's where things get really crazy. This is expected to grow by 2032 to $505.3 billion. That is astronomical growth, and that's a compounded annual growth rate of about 9.7%. So we are looking at a market that is about to absolutely explode. Yes, it's already large, but it has so much more potential to grow, and here's why MasterCard could be a big beneficiary from this. In 2022, MasterCard had about 27.41% of the market share when it comes to purchase volume. So a company that is second in market share is definitely set to be a huge beneficiary from the digital payment market growth that we're about to see. And here's what we have to understand when this market size grows. MasterCard is going to benefit from what is known as the network effect. And the network effect is essentially when the value of a particular good or service increases for both new and existing users as more customers use that good or service. So as this digital payment market increases, the value that MasterCard can provide to their users increases as well. So the growth runway for MasterCard is set over the next decade, and they're definitely generating enough free cash flow to benefit from this growth as well. So now we need to answer the question, is MasterCard trading at $462 trading at a good value? Should we consider adding it to our portfolio at its current prices? And to answer that question, we do want to jump into my valuation spreadsheet. But before we do that, there's another valuation that I want to look at that I haven't used much in the past, and that is what's known as a reverse discounted cash flow analysis. And essentially the idea behind our reverse discounted cash flow analysis is we want to see how much free cash flow growth is currently priced into this company. So as of right now, we have no free cash flow growth priced into the company. And what's the end result of this? Well, we can see if the company never increases free cash flow again, then essentially they're worth around $175.46 per share. Now the current trading price is sitting at $462, so obviously we do have free cash flow growth priced into this company. Now how high is this free cash flow growth rate projection? Well, we can mess with this variable input to find out exactly how much growth is priced in. If I plug in 10%, we come to a reverse DCF price per share of $3.64. So current price is still higher than that, so they have more than 10% free cash flow growth priced in. If I bump this up to 12, we can see we're still not there. If we go up to around 13.2, we can see we start to get very close to the current trading price for this company. So essentially what this model tells us is as of right now, over the next decade, there is 13.2% free cash flow growth priced into this company. So now the question we need to ask ourselves, do we think this is realistic? And to be honest, when I look at these growth rate projections and the current market share that they have and the historical data for this company, I think this is completely realistic. This leads me to believe they could be trading at a pretty fair value. Now, if we keep moving forward, let's go ahead and run it through our other valuations. You can see I've already plugged in MasterCard right here. Beta sitting at 1.07, so a little more volatile than that of the market. Now, the first valuation we typically look at is Graham's valuation, and I think you could argue this isn't the best valuation in the case of MasterCard, but after we plug in our variables like EPS, growth rate projection, and current yield on AAA corporate bonds, we come to an intrinsic value of $269 per share, quite a bit below the current trading price. Now, if we look at the multiples valuation, we can see some comparable companies like Visa, Automatic Data Processing. Price to earnings multiples for these companies sitting in the low 30s, with the average PE sitting at 31.5. And if we use MasterCard's earnings per share and apply that same average PE, we come to an intrinsic value of around $373.63. But here's where things get interesting for the company, and that is the dividend discount model. And that values a company based on how much they pay out in dividends and how much that dividend is growing over time. So I think dividend growth of around 8% is easily possible for this company moving forward. I mean, look at the most recent dividend increases. We have 10%, 11.3, 16.3, and the most recent sitting at about 15.8%. So they are rapidly growing those dividend payments. So assuming a discount rate of about 8.5%, we'd come to a dividend discount model price per share of about $570.24, which is about 23% above the current trading price. So if we jump over to our output tab, we can see the three different valuations that we used give us an intrinsic value of about $404.28, which is a little bit lower than the current trading price by about 14%. Now keep in mind, when I look at the reverse DCF, I do think free cash flow growth of about 13.2% is realistic, and this would lead us more to believe that the company is pretty close to fair value. Now, as for me personally, I don't currently plan on adding MasterCard to my portfolio, but in reality, that's simply because I already own the largest company in their industry, and that is Visa. They're trading at $273.55 per share. This is one of the larger positions in my personal portfolio. Now, both of these companies are extremely quality and definitely set to benefit from the large growth in their market, and it will be interesting to see how each of these companies perform outperform over the next decade, especially when you compare them to each other. So there's no doubt MasterCard is a high quality company, buying back shares, increasing their dividend payments, growing free cash flow per share, and also having high levels of return on invested capital. And I think in the case of MasterCard and Visa, it really boils down to the old Warren Buffett quote, "It's better to buy a wonderful company at a fair price than a fair company at a wonderful price." MasterCard is no doubt a high quality company, and it looks like it's trading pretty close to fair value and potentially could be slightly overvalued, but the growth runway over the next decade is massive. So go ahead, let me know in the comments down below what you think of this company, if you plan on buying or selling, or if you plan on buying or selling its counterpart Visa instead. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.